Head of Asia Equity Strategy, HSBC. Herald, thanks a ton and a very good morning. It's such a pleasure to have you today with us to talk to us about how you feel about India and China in particular. But let's start by where we stand. We went into 2023 with very low expectations for global growth, elevated fears of a recession. But of course, as the year went by, China's reopening, fiscal stimulus in the US and Europe led to risk markets delivering broadly positive performance. And now as we go into 2024, do you think risk assets could continue to outperform?
Yeah, I'm actually quite positive on risk assets. So I would be in equities. You're right. If you go a year ago, things didn't look as good. But our view on India at the time was it might not be good in the near term, but it will do well. And that sort of view we have at this particular point in time as well. What is the situation? We know that bond yields have declined. The US is talking about cutting interest rates at some point in time in 2024. The market is pricing that in. That is good for equities. Now, maybe we've gone a little bit too fast on that regard, and we're going to see bond yields go up because we're pricing a bit too much optimism in. And that will, in the near term, probably weigh on markets globally, and India would not be in a particular exception. But as we go deeper into 2024, and I think this was also the case in 2023, the start wasn't really so good, but the performance eventually will be much better. So we like risk assets. Global rates are coming down. There's no belief that the US is going to go into any particular recession soon. It might happen, but there's not a workable assumption we have at the moment. So that's all pretty good for risk assets. It's just that we rallied a little bit too fast in December and need to weigh in a little bit in January, the start of this year.
So probably take a step back, consolidate, readjust, and then move ahead. Exactly. But I'll take a cue from the Fed, because I think that was the key trigger that led to a sudden surge, a sudden feeling of FOMO over the last 8 weeks, when at least India and the rest of the emerging pack saw flows coming in, even at a time when historically December is a quiet month. Central bank and their defense have still been on the cautious side in terms of their communication. I know the markets were penciling in a rate cut in March, and then suddenly we had those Fed minutes, and that expectation now is pushed down to 6 months down the line. In your opinion, while there will be a soft landing, how do you expect the rate cycle to play out? And this is important because this is going to drive a lot of the flows, and markets, of course, factor in a lot of that before it actually happens.
Yeah, that's right. So the Fed is talking things down, and you see this with a few economists in the US as well. They're saying, hey, maybe this thing is not going to go as fast as you, the markets, are anticipating. This is probably fair. Our own economists are saying exactly the same. They think interest rate cuts will come through in 2024, but in the second half of the year, not in the beginning. But the market was saying, listen, there's going to be a rate cut, and they're going to do quite a few of them, 4 or 5, and they start in March already. That's too early. So we see this recalibration. A step back is exactly what you said. I think that's a very good description of that. But see this as an opportunity to get into equities, not as an opportunity to get out of equities. And I think around the world, there's a lot of people who would have too much cash, too little in equities, have seen the market rally, think, oh my God, I'm missing out. Now markets come off. They are willing to step back in. So I don't think we're going to see massive corrections either. This is a buy the dip sort of market.
Hi. Herald, I'm going to talk about the report, and I've heard a few of your interviews where you've said you've been bullish on China, and you were bullish on China in 2023 as well. Now, some may argue that bet didn't play out as expected or liked. What you also say is that countries like China stand to benefit more in a situation where there are lower bond yields. So two things here. With China's underperformance last year, valuations looking attractive, and China standing to gain more from lower bond yields, does that mean that China grabs more attention from you than India right now?
That's a difficult one. See, I would have thought that is actually the case at this particular point in time. And in the early part of December, you saw this happening. Japan started to fall or underperform, and China started to perform well, just as we had anticipated. And you're right, we've been overweight in China in the last parts of last year, and it didn't work out And our story was really these bond yields need to peak, and then China will do okay. Now, when they then did peak, and it was, October or so, November, you saw that China started to perform. But then some of the other issues in China started to come back. You had some kind of weird policy announcement that they tried to claw back on the gaming industry. That gave people an idea like, what is this policy risk in China? We know that pension funds are still trying to reduce their exposure. I'm talking about US pension funds, reduce their exposure to Chinese equities. And that isn't washed through the system either. So China has not performed as much as I would have thought under these circumstances. India is, for me, a very different story. For China, I think over the next years, you're going to have a flat sort of market, but you want to trade around it, and you want to have these signals, bond yields, valuations, growth are these signals that we use. And you sell then when it goes up again, and then you wait until it comes off and you buy again. So you trade around a sort of kind of flattish trend. India is different. That's why I mentioned you buy the dips. The India market I see upward sloping over the years, but as it comes down, you want to buy in the dip and then stick with that as the market goes back to trend or exceeds that again.
Herald, and this is why I'm going to come back to this question again. While we do agree that both are very different stories and both are not competing in that sense against each other, that, of course, is in your opinion. But what is going to happen to foreign inflows? I know a large part of India's game or gains came in from domestic inflows, but November, December saw FIs returning back to our markets. Do you think that's going to sustain, despite everything that you've noted, indicating the various reasons why China may land up getting a lion's share of these inflows?
Yeah. So if you look at the absolute numbers for India, actually the amount of buying that foreigners can do is still okay. They are not at levels that we've seen in the past. In the past, they bought up to here in India, and now we're only here. So there is still some room to go. The risk, of course, is that China does start to perform. And given the low valuations, if the market rallies, it can go very quickly. People want to quickly allocate to it. Where then do they get the money from? And what people in India believe very often is that their money could come from India. And they're right in that. I'm not going to dispute that. However, a lot of funds are way overweight on Japan. I suspect some of the money will come from Japan. So I think the risk on foreign flows is not as high as what some people believe it to be. I think they can buy more and would not be selling as much in order to get into China as what they've done in the past. So India, that's supportive for Indian equities as well.
So exciting you feel like that, Herald, about India. But let's talk about India a little more detail. India has given positive returns for the last 8 years. I know you and a lot of the other big brokerages outside are still very overweight. India is a structural story, which is what everyone says. But I mean, reality, right? There is a law of averages. There is a time correction, if not a price correction. Do you think after 8 years, law of averages could kick in, which could mean that investors may want to be a little more cautious, even though structurally we're well placed?
Yeah, that's a good one. After 8 years of every year performing well, you'd think, well, there must be a year whereby it doesn't perform well. And that's a very reasonable assumption to make. The way I look at it almost is like India is extremely diverse. There are always some sectors that can do very well. For me, as a kind of an outsider, it's like Indian food. If I go to an Indian restaurant, you can get, there's this fantastic tandoori in the north, and you got idli and uttapam from the south, and the west has got fish curry, and the east has got something like that as well. There's this enormous amount of offering literally on the table, and with Indian equities is with the same. So there's always something that can perform very well. That sounds odd maybe to you, but in a lot of other markets, think Taiwan, it is just tech. There's only one thing on offer, as if it's only tandoori chicken on offer and there's nothing else. So it's much more narrower where that performance is coming from. So first thing, India is diverse and has a diverse set of drivers. Secondly, if we look at the growth profile that comes through in India, that's actually pretty good. So I don't see any reason why it wouldn't perform very well. And lastly, if you look at China and India, for the last decade, in many years, China and India performed pretty much in line. So the outperformance of India wasn't necessarily too special. It's only after 2000, China went this way and India went that way. So that outperformance of India is actually not 8 years, but maybe the speciality of it lies in more in the last 2 or 3 years. So add another year, 4 years, it's not too bad then.
Herald, let's talk about earnings. We're at the brink of the earnings season, which kicks off in a few days back home.
Yeah.
You know, most companies have indicated that third quarter will be a pretty solid quarter for them. And we've seen business updates which are more or less in line with that expectation. What do you think? Do you think earnings will surprise on the upside this quarter? And will the momentum for earnings continue into the next couple of quarters as well? How are you reading into this? Or what are your expectations largely here?
Two things on this. So first of all, on just looking at earnings, I think people need to think about earnings not from quarter to quarter, but from year to year. If you invest in a house, you buy a house, and you're not going to check the prices the day after to see if you want to sell it already. I think with equities is a bit the same. Look about the longer term trend in earnings, not so much on quarter to quarter, but that's the first thing. Secondly, I do think that the earnings profile is going to slow in India. Last year you had about, say, 26%. This year it's going to be somewhere around maybe high teens, 16, 18% or so. Why is that the case? If you look at the banking sector, they got deposits in to give out as loans, but there's not much room. So if you want to grow your loan book, you need to get the deposits in as well. And that means you either raise your interest rates, and if you don't want to do that because it impacts your margins, you slow down your loan book. And that means that expansion and growth that goes into the private sector in particular will probably slow down as well. So I think the earnings growth will slow. Now, if this quarter is going to be a wash or going to be bad and below expectations, I'm not quite sure. My suspicion are the expectations are a little bit on the high side. So we're going to be a little bit careful, but the overall numbers for this year will be good. And the beauty of India, and actually Indonesia has this as well, is that if you look at the underlying drivers of this, think about, for example, retailers. They are gaining market share over mom and pop stores. You see investment being laid out because India is going through an investment program. New infrastructure is being put in place. I was in Tamil Nadu a couple of months ago and drove around to see temples. So half of the road you can actually be on a highway, but then suddenly the highway stops and you go through small roads that go through paddy fields because the highway is not there yet. So infrastructure is being built out, and the benefits that come from that will come out over the next couple of years. The interesting thing of that is that these are all long-term drivers of growth. That doesn't disappear from one quarter to another. So I'm quite positive, therefore, on longer-term growth potential in India. I think over the next 2 or 3 years, you're going to see an average 15% growth in that market. That's pretty good.
Phenomenal. Well, Herald, stay with us. We'll take a quick break. We'll come back. We'll talk about your strategy in depth, specific to India. Welcome back. We're in conversation with a very special guest, Herald van der Linde, Head of Asia Equity Strategy. HSBC joins in. Herald, I want to quickly start talking to you about sectors that you're optimistic on with regard to India. Would you be building stocks dependent on government spend, so especially with continuity of policy? Would that be a theme you would play with? And also, of course, demographic dividends, which are translating into an emerging consumer class in India. That as an idea as well is becoming of interest for a lot of international investors.
That's right. Now, first on the consumer side, I think the way to look at consumers is slightly different. I do a lot of work on demographics in the whole region, but I think where India stands out is that its consumers are basically located everywhere. Contrast this with China. The majority of the Chinese consumer sits in Shanghai, Hong Kong, or Shenzhen, or Beijing, or any of the other key markets there. Fairly concentrated. In other markets, Indonesia is the same. You want to be in Jakarta. In India, this differs. You got thousands and thousands of mid-sized towns, which, by the way, in most countries would be huge cities, but in Indian standards are mid-sized. All scattered around the country. So the secret, I think, with consumer companies in India is not only the product they have, but the distribution capabilities they have to reach to these people. That is extremely powerful. And that explains why some of these Indian companies belong to the most profitable companies on the planet. So that's a sector that we like. Autos is something we like as well. I would be a bit more careful with the sort of exporters, where the global economy is going. Energy offers good value. So that's where I would look in. And the large-scale banks have underperformed last year. I think there's relative value on large-scale banks in India as well. So those are the sectors that I would be focusing on.
Herald, how do you feel about sectors like defensive, railway, specialty chemicals? These are smaller sectors, but they are darlings of the street.
Oh, absolutely. Yeah. There's some of these railway companies that I've looked at last year. I do a class at the university, and I asked students to sometimes look at particular stocks. So I picked some of the railway stocks in India for them to look at, because that's an exciting sector. And it comes back to what I mentioned. I was in Tamil Nadu, the infrastructure is being built out, the growth benefits from that come, and you can play that through in many ways, but the building companies or the railway companies would fit very much into that particular theme. So yes, it's something that I like as well. And then you go deeper in the market, right? These companies are kind of mid or small caps actually in many cases.
And do you think, Herald, while there is excitement in the broader markets, and if we are talking about the growth that we are, which is 15%, CAGR for India going in the next 5 to 10 years, the small and the mid-cap stocks have to do the heavy lifting. Ironic, because if flows have to come in, they're going to come into the large-cap space. How does one play that out? Because your small company or a mid-cap company has to become a large cap, and HDFC can only do that much if India's got to grow at the pace we are.
That's right, but there's still a lot of growth out there for some of the large caps, so I'm not so worried about that. My worry is more that some of the small cap stories are really interesting, but they perform very, very well. So on a relative basis, I would prefer the large caps. And my worry is also with small caps, the liquidity can dry up. So the moment you say, oh, this is great, and everybody seems to be trading in it, you don't look at it for a couple of weeks, and then you say, let's look at it again, you want to sell, and turns out the stock is going down and there's no liquidity. You can hardly sell unless you really reduce your prices. So I think you're going to be a little bit careful with those stocks as well. I would prefer to stick with a large cap. There's plenty of growth. Don't need to be too greedy. If you have a company that grows 15, 16, 17, 80%, that's pretty good in the world that we live in.
Fantastic. Herald, I've got a couple of minutes left to go, so I'm going to quickly slip in another question. I want to understand from you, what is the risk to India's structural story? I mean, we've highlighted all the positives, everything that's working for India, from the government to earnings to an emerging consumer class, infrastructure, valuations you and me can argue about, but what could go wrong for us? And that's a pertinent question because we've ran up so significantly now.
Yeah, I think there's a couple of risks for India. There are, let's put them like that, there are some risks that are maybe more near-term and that pop up once in a while. For example, higher oil prices would be a risk, the currency moving. Other markets such as China suddenly rallying and sucking out the capital that is in India could be a risk. I would consider those to be more near-term risks. Inflation is always a risk. If food inflation happens, we're living in a world where, you know, the Red Sea and what happens in Ukraine and other places, food inflation could suddenly come back. And that's not good for India. It means your interest rates go up. And I would call them sort of cyclical risks. Then there are risks really about the long-term path for India. I think India could do more in terms of education in large parts of the country. There are parts of India where education is excellent. There are parts of India where education is poor. If you don't address that, these regions will struggle to perform. So that's something that I think could be a risk in the very long run, at least for some parts of India. I think what we see in other countries is sometimes sudden shifts in policy. Now, that is not really the case in India net, but people are very sensitive to that. So if you see sudden shifts in policy, changing regulations for industries, that is a risk that is everywhere. It's not so prevalent in India at the moment, but neither was it in China until a couple of years ago. So that's something people would be quite sensitive to as well.
Very lastly, Herald, you talked about those risks. Now, give me the likelihood of these near-term risks playing out. I do understand conditions are constantly evolving, but from where we stand, how likely is that these jokers in the pack may actually play out?
Well, for the near term, it doesn't really look to be a major problem. The dollar is weakening, so your currency is probably going to be somewhat supportive. That's good for inflation. The oil prices are at least under control at the moment. The picture on the earnings growth is pretty good. And food inflation is not something we are immediately worried about. So they might emerge, but it's not something that I say I can't sleep about this in the middle of the night. This comes back to why you want to buy into dips. It's the risks are moderate, at least from what we can see at the moment. The earnings profile is pretty good. The valuations are high, but in a dip, those valuations come off. So, hey, it looks pretty good.
Herald, what an amazing conversation this Monday morning. Thank you very much for your time. It was indeed a pleasure to get a sense from you on the India story. Well, with that, it's a wrap. We're completely out of time, but thanks for watching Talking Point. There's a lot more on the other side, so stay tuned.